Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. So here's the latest this morning. The National Economic Council Director, Kevin Hassett, reiterating concerns about mission creep at the Federal Reserve. The Treasury Secretary, Scott Bessent, writing in the Wall Street Journal, quote, "The Fed's new operating model is effectively a gain-of-function monetary policy experiment. Overuse of non-standard policies, mission creep and institutional bloat. The Fed must change course." Joining us now to discuss, Alan Zentner, the Chief Economic Strategist at Morgan Stanley Wealth Management. Alan, good morning. It's good to see you.
Morning.
Let's start there. I know you've read the article. What did you make of that? What was your takeaway?
Yes, I think mission creep is one way to redirect the focus on the Fed. Bessent is the only one to think that there is bloat at the Fed, that you've got 300 PhD economists running around and maybe it's a little bit of an echo chamber. And there have been concerns before this about mission creep, especially on the regulatory front. So the article reads like, okay, get rid of all of that, and then they can focus more directly and solely on the setting of monetary policy. That is not going to get the president what he wants, though. But it does redirect the focus on other changes that are needed at the Fed.
Is the president about to get what he wants anyway?
I don't know. I'm sure that he would like to get what he wants, and that is an FOMC that's tilted more toward his understanding of what he believes monetary policy setting should look like. And so you want to be really aggressive here, because if you're thinking about political affiliations on the Fed, and especially the board governors, it tilts away from the president's idea of the appropriate setting of monetary policy.
To build on what John is talking about, is it sort of a be careful what you wish for? Isn't the Fed potentially poised to cut rates, but for the wrong reasons, because the economy is weakening enough to justify the kind of rate regime that Trump has been touting?
Yeah, so yes, that is absolutely correct. And the Fed's going to cut 25 basis points in September, and it won't be enough. And then they're going to cut 25 basis points in the next meeting, and it won't be enough. It's not going to be enough to satisfy the president that wants immediate, drastic cuts in rates. But as a mindful, careful thinker looking at the economy and what the economy needs, you cannot sit on the FOMC today and say rates need to be drastically lower. They need to be lower. They're too tight, especially when you've got a plethora of weakening data on the labor market. It's not just the headline payrolls report. So it's easy to look at these numbers and say, we don't need to be as restrictive. We can make some modest changes here. But one cut's not going to be enough. Two cuts is not going to be enough. But more than a handful of cuts is going to be too much, because we are set for some reacceleration next year, early in the year.
It's interesting that you say that, because in bond markets, people always look for what is that terminal rate, right? Where do we end up in this cycle? And initially, for many months, it was above 3%. Now we've gone well below that, actually, for the end of next year. And I wonder if you agree with that, if you think that the bond market has it right.
Yeah, so I think the bond market is in a difficult spot here, because if you're just looking at the likely path of the economy, we've got business investment that is broadening out more so outside of tech, just tech. You've got a record high tax refund season that's coming. And so you could say, okay, we can adjust rates, maybe 75 basis points, 100 basis points here over the next several meetings. But based on just economic factors, you really shouldn't go further than that, an economy that's set to reaccelerate next year. What the bond market may be pricing in is, okay, up to May, we can probably be sure that the Fed is going to do what's right for the economy. After May, no idea, and the odds are lower than higher.
Would love your guide for the rest of this week before we talk about May next year. Payroll revisions, one. CPI, another. PPI, two. How are you and the team thinking about those data points this week?
So the benchmark revisions, we can surmise that they are going to be net downward. Now, those revisions just cover through March of this year, but it's already a weaker backdrop for the labor market. Now, you could look at that and say, okay, under Biden's economy, those are jobs that are going to be even weaker than before. It's only a couple of months into Trump Trump's presidency, but it does set the trajectory lower at a time when we've got changeover in staff at the BLS, and it's going to be all too easy to point fingers at that time. So you'll probably see some changes at the BLS this week as well. That will further raise the specter for, can we trust this data? So there's going to continue to be a lot of volatility around the data. The inflation data, that's secondary for me this week.
Is it really?
Yeah.
Interesting.
Yeah.
Do you not trust the data?
Oh, no. I trust the data. I trust that it's as good as it ever has been. We're trying to measure a massive data set where you can change the seasonal adjustment factor by 0.001 percentage points, and it gives you an 80,000 K difference on payrolls. So who's to say what's right and wrong?
Stay with us. More Bloomberg surveillance coming up after this. Joining us now is Jim Bianco of Bianco Research. Jim, welcome to the programme, sir. We've got the highest yields in the UK since the late 90s. We saw that in the last few weeks. In Japan, record highs. The good news is in the United States, yields have actually backed away from 5% on a 30-year at the long end. But, Jim, something has changed, and we'd love your thoughts as to why you think things have changed.
Well, it depends on which country you're talking about. If you start with Japan, they calculate taxes in their inflation rate. And if you take that out, their inflation rate is higher than the United States' inflation rate for the first time in 50 years. They've got a real inflation problem. They've also got a debt to GDP twice the U.S. at 225%. So you've got a country that borrows massively, has inflation, is talking about easing. Okay, that's going to drive your yield straight up. And that's what's been happening. In Europe, they've got something similar to that. They've got huge deficits. They've got huge deficit spending. And they've got a loss of confidence. Just to take France for one example, their 10-year yield is within 10 basis points of Italy's 10-year yield. France has never traded at a higher yield than Italy, and they're just a handful of basis points away from doing that. Who would have ever thought that the rock of stability for Europe is Italy? Maybe that says a lot about Europe, that Italy is its rock of stability.
Maybe it says that Italy is just, in a better shape because more people like to visit, Jim. I mean, look, when you take a step back, there are two schools of thought here. On one hand, you could say yields higher in Japan, yields higher in France, yields higher in Great Britain, all lead to higher long-term yields in developed markets globally. There's another way of saying, actually, this makes the U.S. look even more like a haven and sends people back to the United States, even though there are doubts about the U.S. fiscal situation. Which side do you line up on?
Oh, I think that all the developed world government bonds trade more or less in lockstep. So if they're all going up, it's going to put upward pressure on the U.S. And you could argue that it has put somewhat upward pressure on the U.S., despite whatever we think about falling inflation and everything in the U.S. is going well. We were at 3.6% on our 10-year yield a year ago, and now we're at 4.1. We were 4.2 on Friday. So we've also got higher yields, just not as high as those are. And also, there's also another warning sign, too. All the European markets are cutting rates, and their long-term yield goes up. This idea that you hear in the marketplace, cut rates and mortgage rates go down, it's not a given. It didn't work last year when the Fed cut rates, and it's not working in Europe, cutting rates to push long-term yields down.
This is only true, though, if you do have a Fed that is biased to cut rates, even if inflation isn't necessarily tame. It's not necessarily true if the Fed is cutting rates in the face of real economic weakness, which is what a number of traders are starting to price in, at least in the bond market on Friday. Where do you see things shaking out? Is this the Fed that seems just biased to cut regardless of inflation, or is this really a Fed grappling with a dramatically weakening backdrop in the United States?
I think it's a Fed grappling. At his July press conference in Jackson Hole, Chairman Powell said that the labor supply and labor demand are both falling, and he used the word oddly in balance. Now, what he means by that is kind of the thing we don't talk about when it comes to the payroll report. Yeah, we talk about 22,000 jobs. We talk about how many construction jobs we had or how many retail jobs we had, but we're not talking about how many do we need. How many does the United States need to create in order to have the break-even rate? And that's driven by population. And our population is driven by immigration, and we have closed the border. and our population growth might be approaching zero, and 22,000 jobs might be all we need. And if it is all we need, then we don't have any excess capacity. And if the Fed wants to cut rates to stimulate an economy with no excess capacity, they're just going to create more inflation. This is the question that needs to be discussed, and it's not really being discussed. The chairman admitted it, it's oddly imbalanced, but then he kind of said, well, I'm afraid that things might be going bad, so we better cut rates anyway.
Jim, it reminds me of something Governor Carney said at the Bank of England maybe close to 10 years ago after Brexit. He said something like the speed limit of the UK economy had changed before inflation starts to pick up because of the damage done to the supply side of the economy. Jim, I imagine this is where you're taking this conversation. Do you think the Fed is there? And do you think it raises questions about the kind of guidance they can provide after cutting rates at this meeting next week?
I think the Fed is there, that they understand the argument that the supply side of the labor market is coming down rapidly, and it isn't about how many jobs, but how many do we need. I think where their problem is, if I could be honest, it's a political problem. Do they want to say that out loud? Does the chairman want to go to the lectern next week in his press conference and say, look, 20,000 jobs is enough for the United States because we have no population growth? I think he's definitely afraid to say that, because if he does and he's wrong, the whole institution will be permanently damaged. So they're going to err on the side of easing, and it's what they're going to do. And the real question is, are they erring by easing? And that's only going to be known over the fullness of time, whether or not they do overstimulate. Yeah, it is a lot like Brexit. Something has changed in the supply dynamics of our labor market, and we need to kind of understand it.
Jim, I do think there's a simple way to navigate that, though. Diplomatically speaking, you can anchor your view on the labor market around unemployment, or you can anchor your view around the labour market on payrolls growth. Now, something changed, Jim, for the Federal Reserve Chair, because in the last news conference, he anchored it around unemployment, and in Jackson Hole, it seemed to be about payrolls growth.
Yeah, he's not been consistent on that. And, anchoring it around unemployment means you're looking at demand indicators for the labor market. Are companies not hiring? Well, unemployment would go up. And it largely hasn't. It was at 4.2% 13 months ago, and it's 4.3% today. Payroll growth can be a supply-driven thing. So the Fed has been a bit inconsistent with that. And that's because we've never had to break up the labor market and say, here's the supply measures and here's the demand measures. And we should be looking at things like unemployment or like, initial claims or some of the other things that would be more signifying of the demand by companies to want to hire workers.
Stay with us. More Bloomberg surveillance coming up after this. The economy adding more than 25,000 leisure and hospitality jobs last month amid the weak August payrolls report. Eric Resnick of KSL Capital Partners, a global investor in travel and leisure business, writing the following: consumers are still prioritizing experiences over goods, even as they trim budgets, reinforcing long-term tailwinds for the sector. Eric joins us now for more. Eric, good morning.
Morning, John.
Thanks for dropping by. Would love an update. Would love an update from you about how things are, because only in the last hour or so we had a guest talk about the upper income consumer maybe starting to crack on the edges. Do you see any of that at all?
No, I wouldn't call it cracks at all. We do see the upper income consumer being much stronger than the lower income consumer. We've been investing in the travel and leisure space for 30 years now. And so an operator investing in the U.S. and globally, and I would say we continually see there being a prediction that there's going to be a reversal of what's been a secular trend for 6 decades in favor of experiences over material goods, and travel being the primary beneficiary of that. We don't see a fundamental sign that that's shifting.
They're always going to do it for the gram, and they're going to keep doing it for the gram, and that's what
right.
we keep seeing. So regardless of what happens, I do wonder, though, just on a relative basis, whether you've seen a deceleration in what the upper income tiers of travelers are willing to accept. Are they still willing to pay that extra, whatever it is, to get that even better room or that better experience all around? Or is there a bit of pushback that you're starting to see come into the fray?
I think there is a little bit of, I would say, fatigue. There were a little bit of pricing fatigue. Coming out of COVID, people were willing to pay any price to get that room, to get that trip. And that now has waned. We're in a more normalized environment. So the rate of growth has shifted down. Right, what used to be, coming out of COVID, double-digit growth every year in terms of both price and overall revenue. Now is mid to high single digits for us, which is better than the industry overall. But the industry overall is quite healthy, at the high end in particular. The lower end, the trends are a little bit negative.
Well, how much is that really continuing? The idea that there is this dispersion between the upper income, the lower income, and the lower income is really starting to struggle? Or is there still this sort of desire to go out and travel, et cetera, it's just that not as sort of profligate with their dollars?
The desire fundamentally has always been there, and we don't see that waning. What we do see is the impact of inflation, interest rates on the wallet of the lower end. So you've seen trends in the last 3 years since interest rates really kicked up as a result of inflation. You've seen the lower end hit harder. The higher end has continued to spend just at those lower growth rates than we had, but more normalized. So like right now, our bookings are up mid to high single digits as we look forward over the next 12 months. That's good, healthy, a good, healthy trend. It doesn't, the news cycle, right? The report on jobs, where hospitality added 28,000 jobs, last month, last quarter. That is surprising to many. It's not surprising to us. The resiliency of travel, going back, having done this for 30 years, is something that never surprises us, but always seems to surprise the media. No present company excluded.
No, of course, we're dialed in. Every time we see a move on euro dollar, we often joke that people are going to stop going to Europe. Euro dollar 117.29. Could you give us some clarity on that? How much do things move based on a 10% move in the US dollar, based on the exposure that you have to travel properties around the world?
I would say 10% moves don't move that much. We see that. Right, we've seen that in the pound over time. We've seen it in the euro. What does move people? The Japanese yen being 30% weaker than it was. Right, that definitely impacts trends from Japan into Hawaii. In particular, that's the market we see that being most impactful for us, being in the leisure business. What that break point is? Do people move between 10 and 30? Yeah, somewhere between there, I think they do. I can't answer where that line is, but I don't think that line is around 10.
Does the political tension ever show up? Some of the political tension has driven some of those currency pairs. And we've talked a lot about how Canadians will maybe stop and come south of the border. Have you witnessed any of that? Are the accents changing around the properties?
We do see a little bit of it. Canadian travel to Hawaii and Palm Springs, for example, down meaningfully. Canadian travel to our Mexican all-inclusive properties, and we just made a large investment in Mexico and the Caribbean in that space, actually well up. So it's a little bit like the common currency. There is a threshold. Most of the geopolitical news is line noise when it comes to travel patterns, but there is a threshold above which you hit, and some of the Canadian and U.S. tensions, if you will, I think got above that level where it did start to impact travel patterns. In fact, actually, this is a stat I'm not proud of, but the U.S. is the one country out of 184 that are tracked by the World Tourism and Travel and Tourism Council that is negative on international arrivals this year.
Which raises a question going forward. As you make acquisitions, as you make investments, that's what you do. How much are you seeing opportunities continuing in the United States, given valuations, given some of these concerns? Mm-hmm. Are you getting more active, or are you still kind of sitting on your hands waiting for things to shake out?
Well, we see there being a large amount of opportunities across the world to invest in travel. It's not just a U.S. thing or a global thing. Right now, we're still seeing overall transaction volumes down 30 to 50%. We do see the early signs, and we've talked about this before actually here, I think a year ago, but we've seen the early signs of we have lower interest rates, we have an increase in NDAs being signed, an increased number of called fireside chats of kind of early stage conversations between buyers and sellers about potential transactions. Those early signs are definitely here. Coming out of the summer, you've seen that kick up just in the preparation of that for the last week post-Labor Day. So we anticipate that over the next 6 months, activity on the transaction side will get much more active. We've been active, but still, it's been more idiosyncratic deal flow, right? That transaction I just mentioned, we bought $2 billion of hotels from Hyatt Hotels in Mexico and the Caribbean, or announced it rather, will close later this year, but announced that a couple months ago. So we've been fairly active, but we see a lot more activity in the forward-facing mirror.
Stay with us. More Bloomberg surveillance coming up after this. Tobin Marcus of Wolfe Research joins us now for more. Tobin, Tyler said it, a $350 billion fund to help South Korean firms expand right here in the United States. How much did we complicate things over the weekend?
Well, I think there have been a lot of complications throughout the trade agenda for a while, and a lot of tensions between different elements of the president's economic strategy as it pertains to manufacturing in the U.S. and getting these investments into the U.S. You have, on the one hand, these big investment incentives in the big, beautiful bill. On the other hand, both tariffs on inputs and immigration restrictions do pose significant challenges for firms who want to manufacture in the U.S., whether they be domestic firms or international firms. I think we're seeing signs of labor availability being an issue in the jobs data, among other things. So, even in the Japan deal that they did finally execute the reduction in the auto tariffs with the executive order from the president last week, the details about that big investment fund that they pledged, which has been characterized very similarly to the South Korean one, remains somewhat thin. I think there are a lot of balls up in the air on this one.
Tobin, how much political risk is there domestically in some of the nations that are negotiating trade deals with the U.S.? I'm thinking you mentioned Japan and the trade deal that they came up with, and Prime Minister Ishiba is stepping down after completing that plan. I mean, how much is the pushback not necessarily coming from the politicians, but from the different populations of a number of these countries?
Yeah, it's a real challenge. Prime Minister Ishida in Japan obviously was under a lot of pre-existing political pressure. Similarly, the South Korean political situation has been very, very unsettled over the past several months, even separate from those trade talks. It is, I think, a political liability for the leaders who are executing some of these deals in countries that have some of their own pride and a sense of domestic, among the domestic populace, so they shouldn't be just giving the U.S. whatever they want. I think there's less backlash than some of the cases where it's just an existential threat to the country they had no ability to do much about, like Vietnam, which of course also has a more authoritarian political system. But yeah, in South Korea, in Japan, even in the EU, there's definitely some signs of backlash from getting what they would characterize as the least bad available deal in a situation where the U.S. had them over a barrel.
Tobin, do you think that this DHS raid, the ICE raid, was part of a coordinated effort on the part of the administration to put out a multi-pronged policy of both the tariffs as well as trying to encourage domestic training and domestic hiring? Or do you think that this indicates departments that might not be working in sync with one another?
I think there's a real tension between the goals here. The remarks from President Trump that you played a moment ago, he talked about, we need to figure out some way to get highly skilled people here. But I think the folks in the administration who are in charge of immigration policy, up to Stephen Miller, are not huge fans of legal immigration either. It's sort of easy to say, but then doing it is another thing. We saw even in the first Trump administration, they, kind of ground down the pace at which visas for high-skilled legal immigration were being issued. Similarly, we've not seen that ramp up here. If you're trying to create some big new expedited pathway, you would need to work with Congress, and I see no appetite whatsoever to do that. So, I think that there is a sincere commitment to immigration policy from the entire administration. They're pursuing that for its own sake, and to the extent that it creates difficulties for the other aims of the administration in terms of promoting manufacturing, that's just collateral damage.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.